Hey guys, it's John here. In this video, I want to talk to you about the ETFs that you may want to consider to buy in this bear market. The ETFs that we'll discuss in this video will be made up of 5 parts. The first one is the index funds. The second one, the inverse ETFs. The third one is the options ETF. The fourth one is specific sector that potentially can hedge or can do better in the downturn. And then the fifth one is the commodities ETF that you may want to consider as well to hedge your risk. I want to let you know that this video is not financial advice. This is just a general information only that's available to everyone, that everyone can go to Google and type it in. But I'm just compiling all this information together for you to do more research. I'm going to put all the links of this website so that you can do further research. So let's get straight to the video. The first one is index funds that everybody knows about. It's about Vanguard or VOO, and it only costs you 0.03%, which is very low for your expense ratio. It's a passive index fund, and it's gonna give you about 1.43%. And the risk here is 4, as you can see, and this is a website from Vanguard itself. So this is their official website. Another index fund is SPY, SPY. It's also gonna track S&P 500, but they are a little bit more expensive, 0.0945% compared to VOO, which is 0.03%. I personally invest in VOO. SPY, if the management cost is a little bit higher, okay? But, you know, you can do more research about it. Maybe there's a reason why. And it's 0.0945%. And then if we look at the dividend is 1.46%. So it's a little bit higher than VOO. Oh, hang on, it's 1.43%. Okay, so it pays a little bit more on dividend. Maybe that's why. Okay, but just do more research about it. And you're wondering, okay, index funds, why are you talking about index funds? And then, you know, the strategy is pretty much just dollar cost averaging. It says here dollar cost averaging works best when stock market is volatile, which is now is volatile and it's sort of going down. And then if you just keep on buying when it goes down, then you'll be okay if you are investing over a longer period of time. And also it says if you start investing immediately before a stock market correction, okay, maybe the correction happened in around January, okay, we may bounce back, but who knows? The dollar cost averaging will perform better than investing a lump sum. Again, it's different, right? When we talk about dollar cost averaging, some people put it every week, some people put it every 2 months, every quarter, every month, and it all depends on the market at the time. Over time, you're gonna be okay because you are in it in the bear market, you're in it in the bull market. So overall, you will do fine. The next one is we're gonna talk about inverse ETFs, and this is the pros and cons. Inverse ETFs allow investors to make money when the market declines, and it also can help investors hedge their investment portfolio. And there are multiple. The converse is the inverse ETF can lead to losses quickly if investors bet wrong on the market's direction. Okay, so it's like betting. Now, when we talk about inverse ETF, now you're betting the market to go down. If it goes the other way around, then you either need to cut your losses or you need to put a stop loss. Okay, so this higher fees exist with inverse ETF, and inverse ETF held for more than 1 day can lead to losses. Okay, so it's depending on what. Now, the inverse ETF that's pretty popular is SH. Okay, short S&P 500 SH. Okay, and then it's gonna cost you about 0.88%. Okay, there's no distribution quarterly here because the last distribution was on 23rd of March. Okay, so in 2022, there's really never any distributions here. Okay, oh, there's one actually back in 2020. There was a dividend paid out. Okay, pretty interesting. Okay, if we go back to 2019, it's also, oh, all right, they also paid dividend in 2019. All right, that's pretty interesting. So yeah, you also can get dividend. I'm not sure how the dividend can get calculated or get paid out on a short S&P 500. I don't know. Okay, so the next one is also called PSQ. All right, PSQ is the inverse for NASDAQ short QQQ. QQQ is the NASDAQ 100 that you also buy that. And yeah, they pay about 0.95%. Okay, so that's a little bit higher, and Nasdaq has dropped about 30% when I make this video. Also, there's a distribution quarterly. Okay, so let's see the distribution. Okay, there's none in 2022. There's none in 2021. Okay, there's some in 2020 there. Also 2019, there's some dividend. 2018, some dividend, and 2017 dividend, and then after that there's none. Okay, looks like they paid dividend when I don't know, probably in the bear market. Okay, so again, this is quite interesting. All right, so that's PSQ, SH and PSQ. The other one is also called SARK, which is the Total Capital Short Innovation ETF, where a lot of people are buying ARK, ARKK, and then that ETF has done really bad. So somebody made an ETF called SARK to take advantage. As you can see, they've done really well here. Should you do or buy SARK? Okay, I'm not an advisor, so you need to do more research whether that really suit your portfolio, because whatever goes up can go down as well. Okay, so you just need to be very careful there. And in this SARK, the expense ratio is about 0.75%. Okay, still a lot higher than 0.03% in VOO. So yeah, that's SARK. And if we just put everything together between S&P 500, SH in year to date, you can see S&P 500 has dropped about 18%, negative 18%, and SH has given you 19% here. And also PSQ, which is the short, has given you 31% if you are in it from the year to date, from January the 1st. And SARK has given you 75% in year to date. This is crazy. All right, 75%. If we look at the last 1 year, it gives you negative almost 5%, and then 1.25% in short S&P 500. Nasdaq short is about 5.97. SARK give you 111%. Okay, that's crazy. Okay, but then they only started in November 2021. I personally don't have SARK. I would be smiling if I bought into SARK. I'm interested though, but I actually haven't got into it. So another strategy that's going to talk about this video is a covered call options ETF strategy. Okay, so covered calls are an excellent form of insurance against potential trouble in the market. When an investor with a long position sells a call option, okay, so when you sell a call option, then you potentially can earn about 1%. Like you can do this call option with normal shares. But what this does is it's an ETF, or like an S&P 500 covered call ETF, and then they are selling a call option that can earn you a monthly income about 1%, which I'm going to show you later. Okay, so these covered call strategies were once exclusive province of sophisticated options traders. Okay, so this is for trading, for options trading, but it's been started in early 21st century. Okay, so it's going to give you potential for higher return. You can see that you can make more money there, and also like guarding against volatility, which usually with covered call, when it drops, it doesn't drop as much as the index. But when it goes up, it's also not, you're not going to make as much money when it goes up. Okay, there's a reason for it. All right, so it's a different pattern of returns. Okay, so I'm just going to give you like the basic, so I'm not going to go into detail of what is a covered call option, but this is just another strategy because we're just going to discuss about how much it's going to cost you and your potential return. So in here, we're going to talk about the S&P 500 covered call ETF, which is called XYLD. And it's going to give you a high income potential, monthly distributions, and also efficient options executions. The expense ratio is 0.6%. The net asset is 1.57 billion. It's not huge, but this is very interesting. If you look at their 12-month trailing yield, it's about 11%. Distribution yield is about 13.21%. Okay, this is the monthly. And if we click on the distribution history, you can see that they have been paying dividend every single month. This is 2022, 2021, like every single month. They've been paying distributions, monthly distributions. So with this strategy, you can earn a lot of income if you are in that stage. But we're gonna compare this ETF with a normal VOO or a S&P 500 to see if there's anything that gonna give us some red flag. Okay, but let's talk about that later. Another one is called QYLD, which is the Nasdaq 100 covered call ETF. Okay, so it's high income potential, monthly distribution. It's gonna cost you about 0.6% in the expense ratio. And the distribution yield, look at this, 12-month trailing yield, 16%. It can give you 16%. Or distribution yield is 13.49%. Okay, if we click the distribution history, again, look at that. Every single month, you're gonna get paid about 1.5%. All right. Now let's put that index. Okay, so we have got S&P 500 here and Nasdaq minus 30%. Okay, so this is year to date, guys. And if we just add, say, XYLD, and then we're gonna put QYLD. Okay, as you can see here, the price return, S&P 500 only dropped about 18%, but XYLD only dropped 13%. Same with Nasdaq. Nasdaq dropped about negative 30%. QYLD only dropped 20%. So, like if we are dropping, I don't know, another 10, 20, 30%, doesn't really matter. Maybe this could be a good strategy if you want to earn income while the market drops. However, if we look at the, say, 1 year, all right, so you can see here, the Nasdaq is negative 10%, but QYLD give you negative 20% in terms of the price return. And XYLD drop even further, 9%, and then while S&P 500, negative 5%. So you can see over a long period of time, even though it follows the index, but this strategy is not great if you are in, it doesn't give you the same amount of capital gain. All right, so that's the catch. All right, so whether you want the income every month or you actually would like to have capital gain just following the index, then that's something for you to decide. Moving on to the fourth one, we're going to talk about the ETFs that may do better, like certain sector that may do better in recession. Okay, now this data will give you which of the sector that will do poorly or better. Okay, so back in 2008, as you can see here, CONS, which is CONS is a consumer staples. You can see that consumer staples dropped 15%, healthcare dropped 22%, utilities dropped 29%, while the S&P dropped 37%. So 1, 2, 3, these three sectors, they will do, they are not going to do as bad as the S&P 500 because they are defensive stock compared to the 37%. But if you look at these consumer staples, right, back in 2021, it only goes up for 18%, while the S&P went up by 28%. And the same one here in 2020 is only 10%, 10.8%, but then the S&P 500 up 18%. All right, so this is a defensive sector that not gonna perform worse than S&P 500, but also not gonna perform better in the bull market. And if we look at this sector, the year to date, at the moment, the energy sector is killing it. The year to date is 46%. And then the utilities is negative 0.24%. Healthcare is negative 8%. consumer staples is negative 8.93% compared to like 19 point something percent in S&P 500. All right, so what are these ETFs? The first one is VHT under Vanguard for the healthcare sector. Okay, the expense ratio is 0.1%, and it's gonna give you a dividend about 1.27%. But bear in mind though, it has got more risk here. The risk and reward, like once you are picking up the sector, then it's actually increasing your risk. Like you may do better, but overall it's going to increase your risk, and also you need to rebalance your ETF maybe every quarter, every month. So it depends on how much work you want to do. The other one is called XLV. Okay, the healthcare for State Street or the Spider Fund. It's also going to give you 0.1%. So it doesn't really matter whether you go Vanguard or this XLV, it's going to cost you the same, 0.1%. That's gonna be just looking for the dividend. Dividend is about 1.48%. Okay, so it's kind of similar. The next sector is the utility sector, which is VPU. It costs you 0.1% and also 2.83% of dividend yield. Okay, so that's for the Vanguard, VPU, or XLU for this utility sector. Again, it's the same, 0.1%, and it's gonna give you 2.84%. All right, so that's the utility sector. The third sector we're gonna talk about is the consumer staples. Okay, consumer staples is also 0.1%, the same risk, 5, and also 2.11% dividend yield. The same with Spider, which is XLP. It's gonna give you 0.1%, and it's gonna give you the yield of 2.5%. Okay, so it's pretty similar. Now, when we talk about this particular consumer staple, there is another sector that's quite interesting, which you may want to know, which is this one here. This ETF is called Food and Beverage ETF, FTXG. All right, I'll show you why I am interested in this ETF. Okay, so in this ETF, the expense ratio is 0.6%, which is high. Like 0.6 was a lot higher than 0.1%. And it gives you a 12-month distribution rate of 1.56%. Okay, so it's higher fees and also lower dividend compared to the 2-point-something% on the consumer staples. Okay, so this FTXG is actually performing a little bit better than the consumer staples sector. Let's put that in the chart. Okay, so we've got this S&P 500. Okay, I'm just gonna put in VHT, and then I'm gonna put in, which is the healthcare. I'm gonna put in VPU, which is the utilities, and then I'm gonna put in VDC, which is the consumer staples, and I'm gonna put in the FTXG. All right, here you can see S&P 500 drop about negative 18%. And as you can see, VPU only dropped 0.19%. VPU is the utilities. But I'm not sure why this FTXG, okay, so FTXG is about 0% price return. So 0% is a lot better than any of this. All right, so while S&P 500 dropped 18%, FTXG actually didn't lose any money. Okay, so they are quite stable. So, you know, like you can do more research on FTXG if you're interested as a potential hedge. Okay, so that's that. Another ETF that we can talk about is the commodities ETF, which is gold, because potentially gold is usually a hedge against inflation, a hedge in recession. Okay, so one of them is called GLD, and it's about 0.4% ratio, like the expense ratio. And I believe that this doesn't pay you any dividend, because if you hold gold, there is no dividend. But potentially it can also hedge you against potential downside risk if you would like some money in the gold ETF called GLD. And another gold, it's not really commodities gold, but what I actually interested on that you may want to know is also called GDX, which is the gold miners. So instead of you buying the physical gold or buying the gold ETF, you can buy the gold miners, which is the companies that produce this gold. So it will cost you about 0.51%, which is a little bit higher than this 0.4, but the benefit of it is you get dividend about 1%, 1.25%. That's that, because all these gold miners, they're making money and they give out dividend. Okay, so rather than you put your money in the gold, maybe this is a potential strategy that you can use if you want to earn a little bit of dividend. Another one is called GDXJ, which is the Junior Gold Miners ETF. Okay, it's gonna cost about 0.52%, and also even lower, 0.49% the yield, the dividend yield. Okay, so we are gonna put that comparison in this. So we're gonna put GLD, we're gonna put GDX, and then GDXJ to see how they've performed in year to date. Okay, so you can see the S&P 500 is about negative 18%, the gold 0.63, GDX 0.09, GDXJ actually dropped almost 7%. Okay, so you can see that gold and GDX is kind of similar. And if we just go total return, including the dividends, not much difference. Okay, so that's the year to date. And if we just go 1 year, GDXJ is actually a lot more. I'm surprised on this one. Okay, and then S&P 500 only dropped 5%. Gold actually dropped 2%. GDX has dropped even further than the S&P 500. Okay, so there you go. When you doing like a GDX or GDXJ, that's actually performed worse. Okay, so if we go 3 years, I'm interested in this. S&P 500 was 44%, gold is 42%. GDX is performing better than S&P 500, and GDXJ is about 42.77. Okay, so yeah, GDXJ is not doing great. Let's see 5 years. Okay, 5 years, S&P 500 outperform all of this. Okay, so thank you so much guys for listening to me until the end. If you get a lot of value from it, I would appreciate a like button and maybe subscribe to my channel. And please let me know which of the ETF that you like the most in the comment section below. And until next time, I will see you guys in the next video.